The stock market, it's been on a roll lately, with the Dow crossing 20,000 for the first time in history. But that all could have been thrown into turmoil, that after an appellate court decision that would have allowed parties to back out of agreed upon trades. But New York's highest court, it overruled that decision, ruling that a trade is in fact a trade. Attorney Martin Eisenberg, he argued the case on behalf of Stonehill Capital Management. I spoke with him a little while ago. So we gave the backstory of this, but explain what a trade as a trade really means, because I know for those who didn't even go to law school, there's a thing called contract law, but this basically etches in that you don't need a formal contract if there believes to be an expectation on both parties what a trade is going forward. That now is the law.
That's first, thanks Rich, it's
Sure.
good to be here. That's right. I mean, this is an important decision because it instills confidence in a handshake, essentially, that when the parties have a deal, they have a deal. And what happened in this case is that my client was the winning bid at an auction, and the seller, which was a bank, accepted the bid. And after the seller accepted the bid, the parties agreed to use a contract of sale. The contract of sale to memorialize the agreement was agreed to. And my client sent over the contract for signature to the bank. And the bank then found out that the loan that they were going to sell, they would make more money if they kept it and didn't sell the loan. So they reneged. They told my client, we didn't sign the agreement, so we don't have to sell the loan to you. And the Court of Appeals of the State of New York said, you can't do that. If you agree on the material terms of a transaction and you agree to the purchase and sale agreement, you cannot just renege on the sale by not signing it.
Now that makes complete sense, but for the layperson out there who says, when I went to go buy my house, you know, I had a handshake agreement or an agreement in principle here, but until I got that contract signed, that house wasn't mine. And then if a bid came on top here that offered more than asking price, or whatever the case may be, they could walk away from the deal. Explain why there's a distinction with a difference here, and as you articulated in your case, without this, people can keep shopping for a better price until basically it breaches what the agreement was.
All right, here's the answer to your question. If you want to have a deal, and under the terms of the deal you want to say, we do not have a deal unless and until we sign a formal purchase and sale agreement, you can do that.
But it's incumbent on the seller.
But it's incumbent on one of the two parties to say that. So if, in a typical house sale,
Yep.
the terms of the sale are typically, we don't have to sell the house unless and until we sign a formal agreement, which gives the seller of the house the right.
Yep.
If a better price comes, the seller can say, listen, I never signed the agreement. We don't have a deal. I'm moving on. And that would be fine. That did not happen here.
And to give a frame of reference, which I didn't know until I looked at this case, the secondary loan market, $628 billion. This is a huge industry, if you will.
It's a tremendous industry, and it has particular application to the investment world, the financial services world. The way traders operate in hedge funds, investment banking, is they make a deal over the phone. They say, okay, you know, we'd like to sell this loan to you, and we'll buy it for, 50 cents on the dollar. And they say, you've got a deal. And they hang up the phone. It's a very volatile market, okay? You then send over the purchase and sale agreement to formalize it, because that typically takes a few days.
Sure.
In that interim, from the time that phone is hung up to the time that the purchase and sale agreement is actually sent, the market can change. And you can make more money holding on to the loan, but you just don't do that. A trade is a trade. And there was a moral obligation on the part of traders not to pull out of trades between the time that you had the phone call and the time that the deal actually got signed. The Court of Appeals of the State of New York said it's no longer a moral obligation, it is now a legal obligation.
Now, this ruling, unanimous, not subject to appeal, talk about the implications of this going forward.
Well, it's interesting when you say it's unanimous. There was 7 judges of the New York State Court of Appeals that ruled unanimously in favor of the fact that this was a deal. The Court of Appeals reversed the appellate division. This decision reversed the appellate division, which is the lower appellate court, which unanimously ruled that there wasn't a deal. So this was a unanimous reversal of the appellate division. So the impact is going to be very good, because I think that now traders have confidence that when they make a deal over the phone, they agree to the material terms, they don't have to worry about a party pulling out of a deal.
Do you think it's going to actually create more hesitation to closing deals until maybe they'll get the authorization 1-2 steps above here, because now they know when I hang up that phone or when I hit send on for that email, this is it?
I think that's a good point. I think now, any trader in this industry that was fast and loose before is going to be a lot more cautious and deliberate in making their trades, which is a good thing, by the way.
Very, very interesting. And again, here, an industry, the scope, I knew it was huge. I didn't realize it was that big. Martin Eisberg, congratulations, and thank you for a few minutes. I appreciate it.
Thank you.
And up next, we'll take a look at some local Valley headlines. Please stay with us.